You are 27 years old, sitting at a desk in a mid-tier asset management firm on the 38th floor in Midtown, running a model nobody asked you to build. The model took you 22 months of early mornings and Saturday afternoons to finish, tracking bid-ask spreads of 44 small-cap equities against intraday volume patterns and earnings whisper numbers. And the model tells you every morning, with uncomfortable precision, exactly where the market is lying to itself. Your title is Quantitative Research Associate. Your salary is $67,000 a year. You are not miserable. You are not satisfied. You are watching the market the way a radiologist watches a scan, looking for the shadow that shouldn't be there. One Monday in March, you find it. A biotech company named Corteva Dynamics has a FDA panel review scheduled for Wednesday afternoon. The options chain is badly mispriced. Volume in the week 2 $28 strikes has jumped 270% in 48 hours. The underlying stock, sitting at $38, is moving sideways, but your model is flagging something specific. The liquidity is staged. It is not organic. It is arranged. You write a 4-page memo. You bring it to your manager, Patricia Wilson, who runs quantitative research with the quiet authority of someone who has survived 3 market cycles and 2 firm restructurings. Patricia reads 2 pages, sets the memo face down on her desk, tells you the thesis is interesting, but the position sizing doesn't support a recommendation, and turns back to her screen. The stock moves on Wednesday afternoon, down 38% in 14 minutes after the panel votes against approval. Every retail account long the stock at session open is erased. Patricia does not mention your memo. You do not mention your memo. But someone else does. 10 days later, a calendar invite appears from a name you don't recognize for a meeting with no agenda at a coffee shop 4 blocks from your office. The man who sits down across from you knows your name, your methodology, and the footnote on page 3 where you cited an obscure 2019 SEC comment letter on options market microstructure. His name is Decker. He tells you he runs a structural trading desk at Meridian Point, a firm that exists in regulatory filings and almost nowhere else. He offers you $215,000 base, a performance structure tied to spread efficiency, and a seat at a desk that is not in Midtown. You take the meeting, you take the offer, you send Patricia a resignation letter, and she calls you within 20 minutes, and the call is professional and warm, and at the end she says, "Take care of yourself," in a way that is not entirely about your health. The desk is in Stamford, in a building that looks like a regional law firm and operates with the internal discipline of something much more serious. Badge readers on every door, biometric entry to the trading room, no cell signal inside the perimeter, a signal-blocking architecture that Decker describes as standard and you understand means deliberate. 9 people in the room on your first day. Decker introduces you as the new flow strategist and explains in 25 minutes what the desk actually does. Meridian is a market maker, not a bank, not a hedge fund, not an exchange in any traditional sense, something older, something more fundamental. You are not a participant in the market, you are a surface of the market. A market maker quotes a continuous bid and a continuous ask on every instrument it covers, in all conditions, without preference. You buy from those who need to sell, you sell to those who need to buy. The edge is not about being right, the edge is about being there. The spread is the revenue, and the spread compounds across thousands of transactions a day into something that doesn't feel like trading, it feels like infrastructure. But the infrastructure has an adversary. On the other side of every trade is a counterparty who either carries information you don't have or doesn't, and your entire professional existence reduces to that classification. Informed flow is danger. Uninformed flow is income. The job is to separate them faster than they can obscure themselves. Within 8 months, you understand the mechanics at a cellular level. You begin to see what retail order flow looks like from inside the book, It arrives in waves after earnings surprises, after Reddit threads, after a financial influencer with 800,000 subscribers posts a chart with 3 arrows on it. The retail participant is almost structurally late. They are responding to price movement rather than anticipating it. They arrive after the information has already traveled. You are on the other side of every one of those arrivals. You do not spend much time on the ethics of it in year 1. You are learning a system. The system is legal. The system is disclosed somewhere in a terms of service document that nobody prints and nobody reads, and nobody is meant to read. The first time it lands differently is a Thursday afternoon in November, 16 months in. A mid-cap industrial company called Barrow Engineering starts climbing. Retail flow pours into your book from payment for order flow agreements, aggregators of uninformed enthusiasm. The stock is up 9% before noon, and the retail participation is accelerating. Then a single institutional order hits your book, a sale, measured, quiet, large. Your model classifies it as informed with high confidence. You adjust immediately. You widen your spread on the offer side. You pull back your ask. But the retail flow keeps arriving. People who saw a green number on a screen and typed a ticker into an app. They are buying. You are selling. By 2 p.m., the stock is down 22% from session high. The institution is flat. The retail participants are not. You made money. You're supposed to make money. But you sit after the close and pull the full session tape and look at the shape of it, the arc of uninformed capital flowing directly into an informed exit, and your desk sitting precisely at the point where the two flows met, earning the toll on both sides of the transfer. You were not the cause, you were the conduit. You tell yourself what the job teaches you to tell yourself about liquidity provision and price discovery and systemic function and orderly markets, and how a market without a maker is not a more honest market, it is simply a less liquid one. These things are true. You are not wrong to say them, but you are beginning to understand the particular function that true statements can serve when the thing being obscured is also true. By year 3, you are co-running the desk. Decker handles the business relationships. You handle the book. You have 5 analysts under you. A risk officer named Tomas, who treats position limits as a personal matter, and a compliance director named Elspeth, who you have never once seen arrive after 7 a.m. Your bonus in year 2 was $590,000. Your parents in Ohio think you work in institutional research. Your brother has started asking you investing questions at Thanksgiving, and you answer carefully and generically and change the subject. You are now quoting across 127 instruments. Your payment for order flow relationships have expanded to include 4 of the largest retail brokerage platforms in the country. When one of their customers presses buy or sell on an instrument you cover, that order travels to you before it reaches any public exchange, before any other market participant sees it. The window you have to process this is measured in microseconds. This arrangement is called internalization. It is disclosed in brokerage agreements in a paragraph that is accurate and invisible. The brokerage receives a per-share payment for routing you the order. The retail customer receives a fill that is technically marginally better than the posted national best bid or offer. You receive the spread, the flow information, and the inventory positioning advantage. Everyone receives something. In a narrow ledger, everyone wins. In a wider ledger, the asymmetry is architectural and enormous. You understand this not abstractly, but numerically. You see it every day in the execution reports. In year 4, a woman named Helena Voss, who runs a quant desk at a Swiss firm, asks you at an industry dinner whether you think about the people whose orders flow through your book, what they understand about the structure they're participating in. You give her the liquidity answer, the price discovery answer, the orderly markets answer. Helena listens to all of it and says, yes, all of that is real. Then she says, and there is also something else. You do not answer. The dessert arrives. There is also something else. You carry those words for the better part of a year, not as a confession, not as a crisis. A counterweight is the right word. Something that sits on the other side of the justification and does not fall off, no matter how solid the justification becomes. You are not manufacturing harm. You are not acting outside the rules. The rules are not a costume. They are real, and you stay inside them. But you have begun to understand that the rules were drawn by people who understood the structure and drew them at a distance from the people most affected by it. And the distance is permanent and structural and generates a very specific kind of money. In year 5, during a flash correction, you earn more in 38 minutes than your entire first year's salary. The number appears, and you look at it and feel something that has no clean name. It is not pride, it is not shame, it is the specific sensation of having become something very efficient at a thing whose full weight you are not permitted to set down. Year 6, a regulatory inquiry arrives from a transatlantic cooperation working group. Elspeth handles it with the focused calm of someone who prepared for this before you knew it was coming. The inquiry runs 5 months and concludes without finding a violation. But during those 5 months, you ask Tomas to run a calculation you have not previously requested. Not your P&L, not your spread efficiency, your aggregate cost to the retail participant relative to a fully transparent exchange execution. The number that comes back is 0.38 cents per share. Across your annual volume, that is approximately $74 million. You are not the cause of the $74 million in any simple sense. You did not steal it. It moved through a structure. The structure is legal. The structure is the market. But you built the spread algorithm. You trained the analysts. You tuned the midpoint adjustment logic. You are not a passenger in the $74 million. You are its architect. You do not change how the desk operates. The market has not changed. The regulation has not changed. There are 8 other desks doing this at comparable scale. Unilateral withdrawal is not reform, it is exit, and exit helps no one and changes nothing. This reasoning is correct. It is also the reasoning everyone in your position arrives at, which means the collective outcome is perfect stasis, and the $74 million renews annually with the reliability of a physical constant. Year 7, you have refined the midpoint adjustment model to distinguish with 81% accuracy between momentum-driven retail flow and fundamentals-driven retail flow. Momentum retail is less informed, more reactive, more likely to be wrong at the entry point. You do not raise the listed spread, you adjust the midpoint fractionally, invisibly, in the direction that optimizes your inventory position. It is within best execution guidelines. It is practically a precise and quiet extraction. You know this, you execute it, you move on. New analysts come through the desk each year, and somewhere in the 3rd or 4th month you see the moment. Each one of them arrives at it differently. A long pause after reading an execution summary, a question that is technically about methodology but is actually about something else. A stillness in the middle of a busy session that has nothing to do with the market. You recognize it because you lived it. You say nothing. You let them sit in it. The ones who leave, leave within 6 months of that moment. The ones who stay find a way to hold the discomfort without letting it disable them. You respect both outcomes. You understand both outcomes. In year 9, the desk generates $210 million in annual revenue. You spend more time now on personnel and counterparty relationships than on the quantitative architecture. The model supervises itself within Tomas's limits. A new analyst named Marcus is 25 and reminds you of yourself in the way that is specific and slightly uncomfortable. He asks you in his 7th month whether you think the people on the other side of your book understand the structure they're participating in. You tell him no, most of them do not. He asks whether that changes your responsibility. You tell him that it sits alongside your responsibility. The asymmetry is real. The function is also real. Both things are true simultaneously, and the job is to hold both without letting either become a reason to stop asking the question. He says, "That's a complicated way to live." You say, "Yes." He stays. On a Tuesday in February, 10 years in, you're at your desk at 6:40, watching overnight futures. A geopolitical event you had been watching peripherally for 2 weeks has crossed a threshold. Equity futures are down 1.8%, volatility instruments spiking in pre-market. Your analysts are already at their stations. Tomas has already sent you a revised limit structure for the open. The retail flow begins in pre-market, panic selling, some dip buying, some volatility ETF purchases from people who are about to learn what volatility products actually do held through a spike, all of it arriving into your book. You widen spreads on your 14 highest volatility instruments, calibrated carefully, not maximally, not because of ethics exactly, but because you have learned over a decade that extracting the maximum from a panic session creates counterparty risk that compounds in ways that pure session P&L does not. You find the level, you set it, the session opens. For the next 2 hours, you are inside the mechanism, hundreds of micro decisions assembling into a session result that will be very large by the time the volatility mean reverts. You are not watching the market from outside. You are a load-bearing wall of it. The retail participant gets an execution. The execution is within a fraction of the posted price. The fraction is not random. It is yours. It funds the presence that makes their trade possible, and it costs them something they will never see itemized on any statement. By 10:15, the volatility is compressing. You sit in the normalizing session and look at the morning's aggregate flow, the panic, the institutional hedging, the spread capture, the shape of it. Somewhere in that aggregate are people who woke up this morning afraid and opened their brokerage apps and made decisions under pressure and got filled within the national best bid and offer and never thought about who was on the other side or why the other side was always there or what it costs when it is there. They do not know your name. They do not know this room exists. They received a transaction, and the transaction settled, and the mechanism held, and the market did not break. You shut down 2 monitors. Tomas sends his debrief request for 2 p.m. Elspeth has flagged a clause in one of the order flow renewal agreements that needs your read before Thursday. The session continues. The questions do not close. The mechanism runs. And the weight of what you have built and what it extracts and what it provides stays exactly where 10 years have taught you to keep it. Not resolved, not buried, present, looked at, carried, precisely calibrated against the full truth of a role that is necessary and asymmetric.